Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. To my podcast. Okay, interesting today. We're going to talk a little bit about why your 401k, what does it really make compared to the spiders? Why is the return so terrible? And if you take 25 years, if you're lucky, a 401k will give you 3 to 5%. Over 25 years, the S&P will give you about an average of 10%. Worst case, 8 to 10. So we're going to talk about that. We're also going to talk about the fact that with this market, where we have this so-called key reversal, it's a question mark whether it is or not. We still don't know because we don't have the confirmation as to if it is or isn't. We're going to talk about that. But in the meantime, as the market gets hit, what group should you be in so you have some safety and you can make some money? So let's start with that first. I'm going to turn to my computer, to my charts first, and let's take a look at that. Okay, so first thing I want to look at is GLD and UUP and XLK. What are those? Those are the three groups that track trends, just like your 10-year Treasury yield, right, tracks the direction of the market. So too the GLD, UUP, XLK track direction. So like the 10-year Treasury yield is your roadmap as to where your market's headed. At the same time, the trackers of trend, okay, is the same thing. It's your roadmap. So the first problem we have is, again, if you look at a stock like, for example, GLD, and again, it's one of the trackers, you can see we've had no breakdown yet. And what do I mean by that? Well, if you take a stock like, let me just give you an example, if I can pick one up here. Let's say, I don't know, I think let's use Qualcomm maybe. Just quickly picking one up here. Hope that's the right one. And another one would be Qualcomm. Another one would be, what was it, CRM? Yeah, CRM, thank you, CRM. Okay, CRM's the best one. Okay, so here's what we're looking for. When we look for a correction, a reversal, GLD, UUP, XLK, they have to all drop at the same time. That has not happened. And we say drop, what do we mean? Right here, you see on this chart, on my Pro 2 right here, those are stochastics, they call them stochastics. And when they hit this white dotted line right here, that's a confirmation you had a reversal from an uptrend to a downtrend. And the further away they get from that white dotted line right there, the further away, you can see this one here, the confirmation gets, deeper and deeper and deeper, meaning, yes, you got a key reversal, and it's getting, the confirmation is getting better and better and better. But we don't have that. So if you look at GLD, we don't have that. It hasn't even broken 80% yet. In fact, golds are going up today. And if you look at XLK, we haven't got anything that looks like CRM. Nothing like that. And here's the interesting one, of course, is your dollar. This is amazing. When the dollar was coming down, it had a severe downtrend. It broke through that white dotted line. That's a confirmation. And stocks gold was going up, silver was going up. God, silver went up in 4 weeks in January, 60%. Gold went up in 4 weeks, 25%. Tech was going crazy. But then all of a sudden, we had this reversal as they're calling it, and you can see the dollar went up, and that, of course, kills your rally. But it's not confirmed yet. Now, obviously, it could get confirmed, these three stocks, as we move out in the future, but it's not now. It's not totally confirmed. That's for sure. So we're being a little misled there. So keep track of that. Now, the stocks that I have my members in, there's only a few groups you should be in that are doing great. The regional stocks, the regional bank stocks, we're doing terrific with Key Bank and PNC and MTB. And we also have, you want to be in the next group you want to be in is industrials. We're doing terrific with Honeywell, FedEx, Caterpillar. These are all just blasting off, Pace Car. So, and then the third one is defense contractors like Northrop, Lockheed Martin. I mean, these are all home runs. And I don't like healthcare because it gets a little fidgety, healthcare. Anything can happen. But right now, what I'm saying to my gang members, stay with what we've been staying with, okay? Just stay with our regionals, stay with our industrials, stay with our defense contracts. If you want to go a little bit with healthcare, that's fine. You got GLD, okay? You got, give me a second here. Merck, rather. We got Merck. There's Merck right there, Merck. And then we have GILD. That's it, right? I got the wrong one. GILD, Guild. There you go. And we got Guild, GILD. That's doing well. Merck's doing well. Johnson & Johnson doing well. But if a family member said to me, what stocks would you rotate to now and stay with? I definitely would just say, stay with your regionals, stay with your industrials, stay with your defense contractors. Those three groups will make you plenty of money until we really see, because they got tremendous relative strength, incredibly. It's all about relative strength. So that's what investors should be doing. But again, typical Wall Street, they always put out optimism when behind the scenes they're shorting the stocks, they're making moves to protect themselves. But when you hear the jibber jabbers on TV, it's optimism. Now let's get to the 401k, because these 401ks are a total disaster. It has not worked, the 401k. Okay, it has not worked. It's a failed experiment. And that's not me talking about it that way. It's the guy who came up with the idea, not me. So the guy his name is Brenner, and Brenner came up with this 401k, and he's saying right now he wouldn't even be in a 401k. He'd rather be in the spiders. Now here's why. If you take and look at the 401k optimism, they advertise, go into 401k, you're going to get 5 to 8%, no problem. Really? Well, that's what they're selling, but when they give you that number, 5 to 8%, they're assuming there's no hidden fees, no fund turnover costs, no wrap fees, no target date for the glide path drag, or the perfect investor behavior, which is a killer. That's a killer. It kills all retirements. But the point I'm making is that's a bunch of BS. Now, let's back in the revenue sharing, the 12B1 fees. Let's back in the trading turnover costs, the glide path, the managed account fees. Let's put all those in there. Okay, you're at 3 to 5%. Where the spiders at 10 to 11%. That's insane. Why would you be in a 401k? And also in a 401k, you're not allowed to sell short. You can't protect yourself. Now, here's the other thing that's interesting. Who manages your money? Do you really know? There's 3 layers. You don't know. They all skim from you, okay? So let's just take the first layer, the bookkeeper, okay, the record keeper. Now, who does that for 401ks? Fidelity's in on that, T. Rowe Price is in on that, Vanguard's in on that, and they get their fee, which you don't see. And then you have the next guy, the plan administrator. Your company does not, even though you're told your company manages it, they don't. They hire these 3 layers. The second layer is the plan administrator. He's a third party, and he gets a big chunk of it. What does he do? He handles compliance. He handles the IRS filings. This is what he does, and he gets a big chunk. And the third one, oh, this is the one I love, the investment manager. Investment manager? Have you seen how they manage your 401k and the stocks in your 401k? First of all, they can't even short them. So when the stocks start going down, the market's going down like you're seeing now with a key reversal. They're not shorting. They're just sitting there, and you're taking a hit. You're taking a hit because, oh, you can't short. That's dangerous. Well, no, it's not dangerous at all. We know why they don't want you to short. Because when the market goes down, they got to hold that market up, and they need you, the retail customer, to help them hold the market up so the stock doesn't fall within 30 minutes. They want to get out of that stock. It takes maybe 3 months for Bank of America and Citi and Goldman Sachs to take care of their pension funds, their big institutions, the steel workers. They got to get them out. So they need you to come in and cost average down. They need you to come in and buy on dips. And they convince you to do that because all the way down, on the way up, you have buy recommendations. All the way down, you have buy recommendations. So when the stock's at 100, goes to 80, goes to 60, goes to 40, still buy recommendations. And you feel good when they tell you, cost average down, you'll do it. Buy in a dip, you'll do it. Because that's what you've been trained to do. They took parking space in your head. Are you nuts? So you got 3 layers that take money from your 401k. Ridiculous. So think about the fees in a 401k, what they charge you compared to the spiders, which you can short, by the way. The 401k mutual funds, they charge 0.5 to 1%. That's outrageous. Spiders, not even 1%, 0.09. Can you imagine that compared to this 401k? They're robbing you, and you're not getting a good manager. The people who manage the 401ks, they're the worst of the worst. Why? Because good managers are managing their own fund. Good managers are pension fund managers. Good managers are hedge funds managers. Nobody wants to sit there and manage a 401k. That's like being a dishwasher in a restaurant. You want to be the dessert chef or something, right? Okay. So that's what's going on. And now the silent killer they don't tell you about in your 401k. The manager, he's terrible what he does. The fund manager, they're awful. So the fund manager, because he's so bad, let's say your fund really, and 401k really starts out earning 7 to 9%. Did you know that? That's what they earn in the beginning. But because they manage your fund so poorly, there's what we call a behavior penalty. And it's the silent killer of your retirement. And that's when you drop from, let's say, the S&P 10.7%, or let's use 10% average, but you get all the way down to 3%. In the beginning, you were pretty close to an S&P, about 7 to 9%. But because they're managed so poorly that you drop from that 7.9% to 3 to 5%, where the S&P spiders stay constant at, let's say, 10%. So see, it doesn't work. It doesn't work. So what the managers are so terrible that they buy on highs, they sell on the lows. This is unbelievable. And they increase contribution when the markets are hot, and they cut contributions or move to cash when markets fall. No wonder you don't make any money. And they chase performance. They're FOMOs. Fear of missing out. They chase performance. They miss the recovery. They miss the cycle. They switch funds at the wrong time. When you're supposed to be in growth, they go into value. When you go into value, they're supposed to be in growth. So I hope this helped you a bit. And again, go to the spiders.